Let's look at your board.
The board.
What's going on there? So
Monetary policy checklist. Let's just go through this, Mark, and fire away with some good
GDP.
questions. I'm putting that into neutral to easing. We're not quite in easing because it's still growing, but the numbers are coming down quite a lot. So if we get another weak quarter in the March quarter, which is probable.
Probable meaning greater than a 50% chance.
Oh, yeah, that we get something, and by a weak GDP result, that's 0.5 quarter on quarter. We need to grow the economy at 0.5% at least per quarter.
What's interesting about this? They when they build the budget, they're usually working on a 3% assumption.
Yeah, high two. I think they've just scaled it back to like 2.75 or something.
Let's
call it 3%.
What does that do for the budget?
Puts a hole in it.
Totally.
Indeed, and the budget's in middle of May.
Yep.
2 months roughly from now. We'll see what the budget numbers hold. I think Jim Chalmers has got an interesting challenge to try to balance his budget again. Because the economy is weaker, if it's weaker, you get less employment, you get less income tax and all the rest of it. So that's a risk there. Inflation, I'm putting in neutral. We had the monthly inflation number come out recently, 3.4. Not quite in the target range, but remember, Mark, and I remember we were spitting chips when it got to 8.4% on that monthly indicator at the end of 2022, 8.4 to 3.4. Wow, 5 percentage points in 13 months.
But Steve, I remember that you and I were quite strong a little while ago saying that the forward-looking inflation, or instead of the backward-looking inflation, which is normally how they operate, was tracking around 3%. If we look forward, based on the quarter.
Yes, based on and indeed, if you look at the December quarter inflation number, that was 0.6. Multiply it by 4, that's 2.5.
Yeah, correct.
So you could almost put that into easing. I'll be a bit conservative. I want to see one or two more numbers on inflation before I push that into the easing column,
but
just in case. But I think we're almost there.
I think my gut feeling is we're there now. If we just say what is inflation like right now, I would say we're somewhere between 2 and 3.
I think we are right now too. When we get those numbers for the March quarter at the end of April, so to be sort of throwing all these dates out there, it'll almost certainly confirm that we're within the target range.
Right, labour market. I'm going to put that towards easing. As we said, 3.4 to 4.1 on the unemployment rate. The job ads down. You don't want it to go high. As you said, I'll just take a step back. Do you know that 3.4 to 4.1% unemployment rate? That's about 125,000 people. Not just an economist talking unemployment rate. Think about the MCG on Grand Final Day with 100,000 people in it. It's that number plus another 25,000 who don't have a job today, who would have had a job if the unemployment rate stayed at 3.4%. As of 31 December.
That's January data.
As of January.
January, yeah.
As of 31 January.
31 January, yes.
So
it's a big human number, if you know what I mean. So here we are, economists, 3.4, 4.1. It's a bloody 125,000 people.
And there may well be another 0.5 sitting in there.
If we get to 4.5, which is the RBA's forecast, you're getting close to 200,000 people unemployed from where we were. That's
what effect is that having on wage pressures?
This is the interesting thing. The wages numbers, I'm putting in neutral because the numbers that we have, and think back, and I don't want to labour this point, pardon the pun, the Fair Work Commission bumped up the minimum wage on the 1st of July. So what was that, 8 months ago? And the federal government ramped up pay for people in aged care, nursing care. That had a big impact on the way wages are measured, as it should. And by the way, I think I agree with, I do agree with what they did.
It's fair policy.
Because wages have been very weak for a long time ago. But what it means is that wages growth is currently at 4.2, but even that masks the fact that in December, it was only 0.9%. 0.9 times 4 to annualise it's about 3.5 to 3.75%. Absolutely in the Goldilocks range of wages. Not too hot, not too cold, just right. So there's nothing wrong with wages growth at 3.5 to 4%. We're basically there now. But I wouldn't cut just on the wages scenario. International economy, we've got inflation falling. European central banks are going to be cutting rates pretty soon, probably be one of the first cabs off the rank. Bank of Canada's not far behind. Bank of England's not far behind. The Fed, there's a hot debate. So we get the next round of inflation data there is going to determine when they cut, not if. when. So the international economy, look, I'll put that in easing. The next move in interest rates in all the big economies is down. No one's going to hike. We're going to be part of that. House prices, I'll put that in neutral. They're still going up, but not rapidly. The rental market's as tight as a drum, as we've discussed many times.
Less than 1% on average.
It's extraordinary.
Across the country.
Rents are going up at 10% plus, depending which city you're in. But so you sort of don't, that's the rate hiking cycle for housing, because if you hike too much, you'll stop developers building property, and we need more properties. But you need to sort of cool demand. I think that's driven more by population than interest rates. But you put it in the neutral case. Retail sales, we've discussed, shocking. Weak as water. We consumers are not silly. We're hunkering down. Cost of living, rate hikes past are impacting our spending. So retail sales are very weak, putting a hole, as we discussed, in household consumption, a really big part of GDP, of the economy. Consumer sentiment the same. Just earlier, we had I think it was the ANZ and Westpac consumer sentiment numbers. They're bouncing around pretty ordinary levels. You'd cut interest rates. They're consistent with the global financial crisis, the early recessions that we had in the 1990s. Consumers are feeling glum.
They're great, very good indicators.
And they're a great indicator, yes. As I said, consumers are smart. They know what's happening to their hip pocket. They know what's happening to their bank balance, every repayment they make, every rent payment they make, every wage that goes in. Oh, geez, things stuff. They go to the supermarket. Oh, my God, it's gone up a lot.
Well, just on that, in terms of sentiment, when does the next national savings number come out? Because, if you recall, our Reserve Bank governor was talking for a long time, and it was coming out in the financial stability report, but she talked about Australians having saved $250 billion.
Correct.
Well, we've got $250 billion, which gave her great pause for the rate rises.
For a buffer.
Yeah. When does that come next month?
I think we may have seen that in those national accounts. I saw.
It normally would have come in February.
Numbers. We did. And I think the numbers come down because the household saving rates come down a bit. I'll have to check. I'll get back to you for our next conversation.
Because I think that's an important.
Why don't we spend a few minutes talking about that next time? Because savings are they are a buffer.
Yeah.
They can keep your head above water, like rate hikes and low wages growth. Oh, geez, I've got savings so I can keep my head above water until interest rates are cut.
We should talk about the next one.
For sure. Building approvals, weak as water. We just discussed we need more houses being built. They're not being built. Property developers going bust. I put that in the easing side. Business investment, we spent a bit of time on that today. Looking fine. Hey. Look, you don't hike rates because business investment's strong. They don't need an interest rate cut to help them along. Business confidence, we just saw the NAB survey, pretty good too. Businesses are way more optimistic than we consumers. Maybe they're linked to the export sector, the business side. So if you're an iron ore or coal exporter, you're doing fine.
But the question then becomes, who does the ABS interview in relation to business investment?
And it depends who answers. They interview many thousands of businesses, and they weight them according to the size. So a BHP or even a Commonwealth Bank, because they have a lot of CapEx on IT and computers and all that sort of stuff, versus a little, well, not quite a corner store, but just say a store with 10 million turnover or something like that. They do weight it, of course, according to the size of the business. But but the business side of the economy, and they also measure it through imports because most of the machinery is imported. So you're buying a computer or a lathe or a truck, we import that stuff. So they sort of can cross-check it against the imports. And actually the imports of machinery has been pretty robust. So that says that business investment's doing well too. Commodities, neutral. I said iron ore's come off a bit or quite a bit, but it's still 110 odd dollars.
Interest rates don't really influence it.
No, they influence the Aussie dollar, but it's at 66 cents, so it's very competitive.
Yeah.
Probably don't need to worry about it. Stock market's booming. I'm going to leave that at neutral, whatever. And current interest rates, I'm going to put that in easing because they're currently 4.35%.